Good morning. I'm in Dallas, Texas today. Thought we'd talk next a little bit more about the daily financial cycle, the process of creating the balances, particularly posting to the general ledger on a daily basis, which attributes are used to make these critical balances that we control the business from, and how those posting processes affect our ability to create other balances. Received some feedback on a previous set of slides that in another video that I hadn't been clear enough in what they meant. They were hard to understand. So we'll go through those in more detail. There's a lot of attributes that are recorded on each one of our individual business events. The attributes recorded typically vary by business event type. For example, purchases will have a different set of attributes from payroll, which will have a different set of attributes from payment, which will have a different set of attributes from cash receipts, and so on. All of these things have various attributes, but there's a set of attributes that we end up assigning to all business events that are common throughout the organization. This every business event that has a financial impact anyway. If we were to take and try to post all of the attributes that were posted or captured upon our business events, it would take far too long. You remember the amount of summarization that goes on, the number of balances that can be made is dependent upon the number of attributes and the values in those attributes possible. If you take all of the attributes, there's lots of different values possible, particularly if we add certain things like timestamp. If you try to create balances for each one of these transactions, each balance basically looks like an individual transaction itself because it is unique. So we can't post all of these attributes because simply there are too many attributes with too many values in each one of those attributes, which ends up creating too many balances and too many transactions that are summarized, producing basically no collapse. They look like individual transactions themselves. So large organizations cannot process the data in time if you try to use all the attributes. These common set of attributes that we assign to every financial transaction cut across what's called the general ledger. And so there's the set of attributes that are used for these critical postings that I've been talking about. These few attributes have fewer values and produce fewer balances, and therefore the number of transactions to post after summarization of them is many fewer. Thus, and these attributes are those that are typically posted to the general ledger. The attributes that are in a typical general ledger, they vary. They've increased in the recent years to a few more, but there's typically at least a legal entity, a cost center or profit center of some sort, a general ledger account, which kind of describes what kind of transaction it is. There can be other things like customer types and product types and those kinds of things that we've added as additional attributes to the ledger. But these are the kinds of basic attributes measured in perhaps fewer than 10 typically that are posted to a general ledger. And they capture all of the business events across the entire organization, every financial business event, every financial transaction. We're going to use these next set of transactions here in the next few slides to explain more about the daily cycle. Let's imagine for a moment that we had this set of transactions for the number of values in the attribute shown here. 5 different attribute values in the company value. Cost center can be 2 different things, city A and city B. Investment deposits, loans are 3 different kinds of things, and product, so on and so forth. From these transactions we can create 600 different balances. Now, the number of transactions could be as small as 25 transactions, but we could make 600 different balance permutations off of those 25 different transactions. Let's imagine for a moment, though, that we have to make these 600 balances, and let's say we have many more transactions than that. So as we move to understanding how we could go about making balances, we could make balances by beginning with the transactions from the first day of the company is originated, and we could add together all the transactions to make the balances that are needed for the first day. When the second day rolls along, we could take yesterday's 600 transactions and today's 600 transactions, and we could make all of the balances that are needed for today. They would show the accumulated year-to-date balances that are required for the organization. Day 3 rolls along, we could do the same thing again. Take 600 transactions from the first day, 600 from the second day, 600 from the third day, and make all the balances that are needed to understand what has happened in our organization since the beginning of time. You can see how the measurement happens here over time. This processing has a very low reconciliation cost, because if there's anything ever wrong on one day and the transaction comes in the next day, that automatically updates all of the balances that need to be updated for that transaction. And we're making the balances straight from the transactions, which are the book of record, the originating source of the information. So it's very low reconciliation cost. But, as you can tell, it has high processing cost, because every day we're repeating many of the processes that we did on the previous day to make the previous day's balances. So this has a very high processing cost. Another approach, the one that we typically use, is that we take all of the transactions to make the balances on the first day, and we store those balances. The next day comes along, we take the balances from the prior day and the transactions from today, add them together, and we make a new set of balances that reflect today's position. The third day comes along, we take the balances from yesterday, add them to the transactions for the new day, and we make another set of balances. So this has very efficient processing, has low processing cost, because we're not repeating processing done on the prior days. But the number of balances we are creating increases over time, because I have to reconcile to make sure that the balances made yesterday, if I have a transaction that comes in that should affect yesterday's balances, that won't naturally get updated as I apply it to today's balances. So reconciliation becomes a problem. There's a high reconciliation cost for using a posting process that adds transactions to balances. When we look at what organizations have done, because there's so many attributes on the originating business events, we see that they had to take a subset, as we talked about, of attributes to make critical balance from which to control the business. So if we took the number of attributes on the bottom of this graph, if there's no attributes, there's no balances. If there's one attribute with 5 possible values in it, then we could make maybe 5 balances out of it. You can see as we go across and add more attributes, there's more and more balances that can be made. When we go to attribute number 4, we're now making 120 possible balances. When we go to attribute number 5, our 120 balances now becomes 480. We have decided these critical set of attributes that we're going to use to make balances to control the business, and we're going to make them very quickly, and the number of balances made from them is quite small. Here's the daily cycle in most businesses. From 12 a.m. to 4 a.m., you might have something happen in the originating source systems for processing, cleaning up from yesterday's transactions and doing all the work that it has to do. From 4 a.m. to 8 a.m., somewhere in there, the general ledger process gets to run. It's the last process that runs every day, because all of the financial transactions for the organization need to be accumulated into the general ledger. So in this period of 4 to 8 a.m. is when we make our 120 critical balances. And because it's a small window, we often don't get 4 hours within which to do this. It often is an hour or less. Then we have to keep those number of attributes small in order to make those balances. Those balances become the key balances by which the business is judged the next morning and controlled for the next day. But it's not all the balances that are needed in the organization. There's a whole bunch of these other attributes that are needed to be measured and understood by making balances off of them. What we do is we then take those transactions back and we apply them against balances from the prior day to make a new set of balances against new sets of attributes. These attributes can be things like customer balances, they can be risk balances, regulatory balances, all different kinds of things to make different attributes, different reports using different attributes against those additional attributes that aren't the critical attributes. What this creates is an issue between those critical balances that are made first thing in the morning and the later balances made later in the day. If there's any difference in the transactions that are taken in the balances that were created prior and rolled forward for the next day, in the way there is adjustment, in the calculations that are done to make balances, if any of those things are different,
then there's going to be a reconciliation difference between these critical balances we made first thing in the morning and these additional balances that are made later on in the day. That begins to decrease the quality of our information. It begins to introduce questions as to what is the right answer. These issues are the real issues of reconciliation, and it's the critical problem that multiple data supply chains introduce into our organizations. We'll talk more about how to fix this in subsequent episodes.